Joining us today. I welcome you to this wonderful episode. If you've been one of our subscribers, I thank you for coming back and checking out, because I know that you've learned a lot over the course of this series of this program that we've been releasing, the videos that we've been releasing. And if today is your first time of having a look at our what we do here, I welcome you. I say a very big thank you for coming. And I know, just search around. I know you will see videos on financial, personal financial planning and management that will interest you, that will give you a lot of tips on how to do it better, because we are here to offer support, to offer advice, to offer insights, to share insights into how to manage our personal finances, how to plan and manage our personal finances better, especially in a time like this, in these uncertain times, a time of great financial and economic uncertainty, where jobs and the conventional, the traditional source of incomes, are being destroyed daily. They are being destroyed. The distortions in the economies and everything, they have negative impact on people, especially the young people and the new entrants into the labor market. So we have come. One of the ways of cushioning such, and ameliorating against such a negative impact of a time like this, being, a time of like this of great economic uncertainty, is impeccable. Is a sound personal financial planning and management. That is it. How to survive in a time like this. So today we'll be sharing on another interesting topic. Today we are looking at investment in a time of great financial and economic uncertainty, just like we have it today. Today we are in a place of great economic distress, that a lot of people don't know what to do. They are feeling overwhelmed. But if you are one of those people who are feeling overwhelmed and you don't know what to do, cheer up. There is a good news for you. You can manage your finances better. You can do something better to survive. Not just to survive, but to thrive also in this time. So without saying so much, I want us to go straight into the topic for today, what we have got to discuss today. So the topic for today's discussion is investment in a time of great economic and financial uncertainty. So in this program, in our discussion today, we'll be looking at the process of capital formation, because you can't talk of investment without talking of capital formation, because there should be a way of mobilizing the capital that you have to invest. So we'll be looking at that. We'll be looking at the role of personal savings in this capital formation. We'll also be looking at the role of financial intermediation, talking of financial intermediaries like banks, in the process of capital formation. We'll also be looking at the chief, which is disposable income. What is disposable income? We'll also be looking at that. And after that, we'll now go into investment proper. In this, when we get into investment proper, we'll look at the different types of investment vehicles, the tools, what you can invest in. After that, we'll also be looking at the characteristics, the types of investment, because there are investment of two types, essentially two types. We are not going to economics. We are talking about personal investment here now. We are not talking of assets in terms of economics and everything. We're talking of assets you can accumulate as an individual. So because of assets that you can accumulate as an individual, because of their inherent characteristics and behavior, they can be classified under two types. Two categories. So we'll be looking at these things based on this thing, so that we will shed more in, and also we'll conclude on this thing by saying, I will be given my opinion on what kind of assets that I think in a period like this that is more valuable It is more sustainable. To invest in. So I will be able to stay tuned. You've got a lot to learn from this thing. So let's go into it. You see, investment in a time of economic and financial uncertainty. The first thing we have to look at is our income. You see, because you cannot invest without talking of your income. When you talk of investment, you see, I want you to know something. The household is the primary unit. Is the primary unit and the primary economic agent in an economy. Everything revolves within the household, around the household. The household is the one that has got the factors of production. The consumption, when you talk of consumption, they are the suppliers of labor. Everything revolves around the household. So the household is the primary unit. Without the household, there is no economy, and there will be no economic activity, because it is the supplier of every economic activity. So I want you to know that. You see, to know that. And this thing, first of all, the chief in our discussion today is looking at we're looking at income. We'll look at what is personal income to a person, and the disposable income to a person, because that is the one that is relevant. The whole income is not relevant for when we are discussing investments. You see, the whole income, the totality of your income is not relevant to the discussion. The only one that is relevant to the discussion about investment is your disposable income. And what is income? Income is, the things that you earn by selling either your skill, what you give in exchange for all those things. The money that comes to in exchange for your skills. These are the basic source of income. The primary source of income is always things you can do for yourself. Like, as a doctor, you can go to work as a doctor. You give of yourself, your skills, and you get paid for that, and that provides a source of income. But that whole income that job pays you is not relevant for the investment when we are talking about investment. You see, because out of that income that you earn, you have to take care of your expenditure. So the income that is devoted to expenditure is not relevant for discussion on any discussion on investments. So if you have not taken away expenditure out of your income, it is still the real income. But after you have taken away the expenditure part of your income, what you spend to make that income, and I have the disposable income. Out of this disposable income is the income that is available to you, either for you to consume, to buy things, to consume out of them, and to save out of them. You see, in our previous videos, we talked about marginal propensity to consume, which is talking about the ability, your disposition, the probability, the point of what portion of your income do you save or do you consume. You see, a lot of people have had, if you say a person has a high propensity to save, that means that out of a high marginal propensity to save, it means that at any additional unit of income that he earns, he has a greater percentage, he saves a greater percentage than he consumes out of that additional unit of income. You see, and marginal propensity to saving is central to this thing we are talking about. Because as an individual, if you have to save, if you have to invest, you have to only invest what you have saved. Or there are two forms of capital formation. For capital formation, talking about the process of mobilizing capital for investment. This is in a technical and professional way. Just how to put it to a layman, how to the process of mobilizing capital, that in an economy for investment. You see, and financial intermediaries like banks, building societies, all those things, they are very key. They are very, very important, you see, to investment, to mobilizing for, because they are the ones, they mop up idle funds from the household and channel it to corporate investments. See, they provide through interest rate, the proper interest rate, the adequate, the correct interest rate, they entice the household to save more. You see, so through the interest rate, they mop up excess financial capital in the households, and gather them together so there will be a pool of funds, and provide a pool of funds that can be used for investment purposes. So for you to invest, it is either you invest out of your personal savings, that is, if you have a high propensity to save, propensity, the portion of your income that you save, if it is high enough, that will provide you an option of capital formation. You can form capital, you can accumulate capital for investment through your personal savings, if you can save so much. If your marginal propensity to save is high, and your marginal propensity to consume is low, you are able to control that. That can provide you an option. Another option is through the financial intermediaries, financial intermediation, which encourages household to transfer idle capital resources from consumption to corporate investments. So you can approach a bank that has mobilized funds, that has mopped up funds from the household, idle funds from the households. You can approach them and they will create new money for you. And in form of bank loan, in terms of financial credit, in terms of credit card, in terms of overdraft and every other thing, for you to invest. So that is very essential. The financial intermediaries, they are very essential. The financial intermediation is a way, if any society must accumulate enough capital for investment, you must have a robust and effective financial system that is capable of setting the right interest rate, the accurate interest rate, the right interest rate, to entice the households enough to save more than they consume. Consumption, don't get me wrong, consumption is okay because it also stimulates the economy. Because if you produce without people buying it, you will not have another money to invest again. You see, the circulation will not go. But there must always be maintained at every particular time an economy that must be prosperous, must function in equilibrium. Optimum consumption and optimum savings. There must be a balance. The optimum, the maximum possible, and the maximum of this possible, they must meet. There must always be equilibrium. Because if one outweighs the other one, there is an imbalance now. That is the same thing about personal finance, personal financial planning and management. You must try always to bring an equilibrium, a match, so that there will not be a mismatch. There must be a balance between the two of them. So that is really what the investment is talking about. So we've talked about income. That income is what you get in return for offering your skills. You see, is the primary source of earning and income. That is The primary source, selling your skills, what you are able to do, what you can do. If you're a doctor, you go to work, you work as a doctor, in the financial, in the healthcare industry, you provide a service and you get paid for that. That serves as an avenue for accumulating capital. That is number one, the primary source. The second one is through financial intermediation, the financial intermediary, which entice the households, the unit, the basic unit of economic activity in every economy. They entice them through the setting of the accurate and proper interest rate to transfer idle and excess capital resources in the household to corporate investment, to a pool of funds. So some funds can be, like £100 can be very insignificant in terms of investments, and everything. But these banks, they pull them, they mop them up from various households and form a pool. And now this money is is enormous, that someone can approach and obtain a loan for you to invest. So these are the things you can do. You can either save to invest, or you can use the bank. So in our last video we talked about that it is not wise to borrow, to rely on bank credit to survive, to eat, to feed. Don't try to do that. Let your first fund be to cut down on your expenditure. Try to see what you can save more on, what you can cut down. You see. So, but now it is a good practice. If you have to invest, you can depend on the bank, because why do you have to? Why is borrowing money from the bank for investment and everything? Why is it always the bank? Don't get me wrong. I'm not encouraging. I'm not saying anything. But it is often better so that you can spread your risk. You see, financial risk. When you do that, because it's no longer just you. If your business collapses tomorrow, it's no longer only on you. The burden is no longer only on you. It's also on the bank. You spread the risk. You see, and the bank, they have to assess this risk also to find out if you are worthy, if you are worthy, if it is worthy for them to take that risk to commit financial resources into your hands, into a business or something. So these are the things that you have to invest in. These are the things that when you are talking of investment, you have to consider. Capital formation. Capital formation is number one. Your disposable income. The size of your disposable income is another one. It's another factor. And your marginal propensity to consume, to invest is also very relevant for any discussion on investment. So when you have determined, there are various investment, different forms of investment instruments out there. You can invest in stocks, you can, there are different stocks. But there are things I want to, personally, I'm just dealing with personal investment. We want to talk about the characteristics, different forms of investment that you can instrument. But their characteristics have made them that the whole investment that anybody can invest as an individual can be characterized under two things. They categorize under two things based on their characteristics and their behavior and how they behave. One, assets that depreciate over time. You see, these are assets, you own them and you can still convert them to money. Assets are those things which are instruments which you can convert to money within a very short period of time. You see, so just like your house is an asset because it can be converted into money. You can sell it off within a very short period of time. Your car is an asset to you because you can sell it off at any time and get money out of it, and get some money out of it. your furniture, a lot of things are asset. You see, like your personal laptop is an asset because you can sell it off. It has a value. Anything that has value and that can be converted into cash within a short period of time. In economics, we'll usually say within 1 year. That is a short-term asset. You see. But so this is just talking about personal finance. We are not delving into economics and defining. We're just talking of something that is relevant for our personal financial management. So what kind of so we've seen it that there are a lot of investments. You see, you can invest. Your laptop is an asset because you can still sell it. Your car is an asset because you can still sell it and get some money out of it. Your house is an asset because you can still sell it. You can still sell it within a short period of time and get your money back. So there are a lot of assets, personal assets to you, which you can buy. So now that we have known what an asset is, assets, due to their characteristics, due to their behavior, how they behave over time, they are classified into two types of assets. The assets that depreciate in value over time. These characteristics, the way they behave, their characteristics, they depreciate. They depreciate in value over time. And you've got the second one is an asset that appreciates over time. Personal asset that can appreciate in value over time. So they are appreciate assets. What kind of assets fall on into the ones that depreciate over time? Things like your car. Once you buy a car, the moment you drive it out of the dealership, the value is no longer the same. It has fallen in value. It has depreciated. It has depreciated in value. You see, the assets that are always that depreciate in value, like these assets are luxuries. They are assets, but they're more like ostentatious. You see, they front luxury, a kind of. You see, your personal laptop. The moment you buy it, the moment you take it out of the shop where you bought it, where you paid for it, the value is no longer the same. You can't take it back. Okay, like in some places, you can exchange it back within 28 days or whatever, So the value remains the same within 28 days. And if you've not even used it, because there is a condition, it must be in the original situation, the condition you bought it, and with packaging and everything, haven't been worn, not having been used or damaged or whatever. You see. So the value stays for 28 days because you have an option of return to return it and get your money back. So that thing, the value stays only for 28 days. But after 28 days, the value is no longer the same. It depreciates. It has depreciated. You can't sell it after 28 days. If you want to sell it, no one will agree to pay that price. It's only a person who I don't know is not a rational. The person that will do that is not a rational economic agent. You see, you are like your car. The moment you drive your car out of the dealership, the value is no longer the same. It falls in value. It depreciates over time as it depreciates with usage. You see, with time it depreciates. It depreciates because there is usage of it. In value. But there are some assets that can only appreciate in value. Once you buy them, the moment you buy them, you pay for them. The same is no longer, you can't exchange them for the same amount that you pay them. You must only appreciate. It can depreciate as well, but there is a higher chance of appreciation with those assets. Assets like housing. If you buy a house for £25,000, let's say 25,000 units of your currency as it may be, in India, in Bangladesh, in Pakistan, if you, no matter how much you buy, once you buy, there is always the likelihood of appreciation instead of depreciation. See, so these are the kind of assets, because of the behavior, they are grouped into these two categories. So based on my experience, I will advise, you see, my audience, my viewer, people that hear me, people that, you watch the video and everything, in your investment, in your investment endeavors, in your efforts, invest more. Try to cut down on investment on assets that depreciate over time. Because assets that depreciate over time, you will not get so much value from them in terms of need, in terms of economic uncertainty. When you have to dispose of them, when you have to sell them to recover some money from it, you will not gain the same money that you invested in them. Rather, invest in assets which appreciate over time, like your housing. Your housing, there is a higher chance of your house appreciating in value over time than decreasing in value. See, invest in those things which appreciate in value, not things that depreciate in value. There is also the option of stock to appreciate in value. Invest in stocks as well. Investment is a way of securing your future, especially in a time of financial, because now, a lot of things, because this is a great opportunity to invest. This moment, this time of financial uncertainty that a lot of people are running, everybody there is a panic in the market. The market is reacting, and a lot of people are disposing of their assets. So now, even cheaper than, even most assets are undervalued now. So it is an opportunity. I've talked about, I said there are mobile apps that help you to invest your loose changes. You can invest as little as £5 in a month, £10 in a month. It's something. Over time, it accumulates into something very tangible. Into something very tangible, into something that you can use, you can depend on. In a time of uncertainty again. So I hope you've learned something. If you've not learned anything, that there are two types of assets. You see that there are two types of assets. Based on the behavior of those assets, there are assets that depreciate in value. So when you want to invest in any asset, or you want to invest in anything, you ask yourself, does this thing, with the value, depreciate or appreciate? Does it have a higher chance of appreciating in value or depreciating in value? That is what should guide you in your investment decisions. Don't be emotional about it. You see, don't be emotional about it in making investment decisions. Don't be emotional about it. I believe you've learned something today, about assets, the process of capital formation, how savings provides the first and the primary source of capital formation. You mobilize by selling your skills, the money that comes to you. If you have developed a high marginal propensity to save instead of to consume, save a higher portion of your income. You see, and when you do that, it will give you a pool of funds for you to invest. And when you want to invest now, or you can as well borrow from banks. Borrowing from banks is okay if you have to invest them, because it will give you a return. Those investments will offer you a return with which you will pay back the loan that you've taken, the credit that you've obtained from the bank. And when you are investing, ask yourself, would this asset, what are the chances of this asset appreciating in value or decreasing in value? Would this asset, is it more likely for this asset to appreciate in value or depreciate in value over time? This should guide your investment decisions. Invest in those assets that have a higher chance of appreciation rather than depreciation, and minimize those investment on those assets which have a higher chance of depreciation, higher instead of appreciation. Things like your house, your vehicles, you see, buying cars or something, try to minimize on them. One car is enough. You don't have to change cars every month, you see. Instead of that, invest in financial instruments, invest in stocks, invest in properties like houses, buy houses, and secure your future. I believe we've learned something. And with this, I want to congratulate you for listening, for taking your time to listen. You see, I know that you've learned something, and this thing that you've learned will be so useful to you at some point, even though it might not be immediately, you might not have a need or to use it immediately, but at a time it will become handy. Even when you're advising someone, you can draw from these insights that you have gained from here today, from our discussions today, to advise the person on what to do. You see, so with this, I will say, okay, have a wonderful time, and please don't forget to check us out next time for our wonderful videos. We'll have a lot of wonderful videos on a number of topics that regarding personal financial planning and management and investments. Thank you very much. I will see you some other time.